Hello, everyone. Welcome to the webinar today. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. I'm so glad you could join us today. We're going to be discussing some multifamily investing strategies and just an overall forecast and outlook in 2025. And I know a lot of you are starting to prepare kind of for that, and this is a great time to do it. So we're going to go over some different questions that we're going to ask here to Gary Lipsky. He is the CEO of Break of Day Capital. We've had Gary speak on a panel with us a couple of times, and he's always brought in some excellent insights. For those of you who don't know Gary yet, he is a 20 plus year real estate entrepreneur. He's focused on multifamily syndication, and he's acquired over 3,200 apartment units, now valued at $280 million. It might be more than that by the time I got your bio. You're working so fast, Gary. He's also the host of the Real Estate Investor podcast. Definitely check that out. And he interviews industry experts to provide a lot of that education to investors like yourself. He's also the best-selling author of Best in Class. If you were at our conference a few weeks ago, you probably saw his book there and maybe even got a copy of it yourself. He also is the founder of the Asset Management Summit and a guest speaker at many conferences like ours. And he's built several companies, and his vast experience really serves as just like a great foundation here for himself as a multifamily operator. And we also have with us Ashley Wilson. Hi, Ashley. It's so nice to have you on this panel. I'm doing just a quick intro. Ashley is the CEO of Bar Down Investments, and she's also the co-founder of Conference Connect and the co-founder of Apartment Addicts, which is an amazing mentorship program for people who are looking to get into investing in syndication. Highly recommend looking into that if you want some more education. She's also the best-selling author of The Only Woman in the Room. We also gave away some of those books at our conference. Maybe some of you got a copy. And also, she's a regular contributor to Rent Magazine, Our Magazine, and has hosted several Bigger Pockets multifamily series. She started investing in real estate in 2009 and has been involved in over $165 million in transactions, managing over 13 million in construction, and really across over 1,500 units. So we have tons of experience here, guys, from both of our panelists, and that truly is the best way to learn. So I am really excited to interview you both. But before we get started, I do need to do a quick commercial for our sponsor. Our sponsor today is K Properties and Investments. They are a 1031 and DST solution. They have worked with us now for close to 5 years. And so a lot of members have gone through them for their 1031 exchanges and have had a great experience. So I'm going to go ahead and just share a quick commercial that they sent over to us to give you an idea of what they do. Just a moment. All right.
You always answer the phone. You always respond. You're very kind. You're always fun.
It always feels good to feel like the only client and person in the world. And I got that feeling.
We've been very happy, and I really, really appreciate you.
You got to know us and understand what we were looking for.
And then we interviewed with you over the phone, and we said, you're it.
There was no high pressure. There was no hurry up and do it now, or you need to do it.
Your team, that's what keeps me coming back.
You folks, both you and other team members, have always been very responsive to me. You've been very helpful.
Would you guys feel like you would recommend K Properties to a friend?
Absolutely.
Yes.
I don't think there's any question that
In a
we would.
heartbeat,
I mean,
yes.
in a heartbeat.
It's like learning a foreign language in a week. It's very hard, and we really appreciate you.
My name is Fred from Huntington Beach, California, and I'm happy to talk about K Properties in helping us select real estate investment.
Go on for hours on how wonderful it is to work with you, with K Properties.
No, honestly, how you explain things. So simple.
Definitely.
And sometimes I know I'd ask the same question 5 times, and you never got frustrated, or at least never showed it.
It was pure education, and we never felt pressured. It was, ask as many questions. We'll do as many Zooms as you want. We'll send you whatever you want. And sure enough, there'd be the prospectus and, all of our questions were answered. And
I really love about K Properties, they have a bunch of educational material.
Yeah.
So happy. And I don't want to say that in past tense because we're still going to have a relationship and I'm sure I'm going to still have questions and one day we're going to sell that other building.
I love about K Properties is because I can sit back, absorb all of the information I see in a PPM.
All positive experience.
We absolutely would refer you guys every time.
He has been very helpful, very courteous, and always gets back to us right away when we have questions and is concerned about what'll fit our needs best. Again, K Properties, we wouldn't hesitate to recommend them to anybody.
All right. All that to say, if you are interested in doing a 1031 exchange or just want to get some more education about it, I do have a quick poll question here. They are offering a free Delaware Statutory Trust Toolkit. So if you answer yes to this, we'll go ahead and send you a toolkit with their magazine, a copy of the book that they wrote on Delaware Statutory Trusts, and also any of their current 1031 exchange properties that are available for DST investments. And so I'll leave that up for just another moment here, and then we'll dive into some questions. Of course, we are recording this, so if you're wondering if you're going to be able to see this later, you will. I will send it to you tomorrow along with our speaker's contact information and the K Properties information as well, just in case you missed it. So let me leave that up for just a second more, and I'm going to close out this poll. All right. So to get started, I also kind of want to know what the audience is seeing as one of their biggest challenges right now. And so we have just another quick poll question here. Curious to see also, Gary and Ashley, what you all think. Is it rising interest rates? Is it identifying good potential markets? Is it rising insurance rates or operational costs? And adapting to new technology or adapting to new laws? And if you could only pick one of these as your biggest challenge today, because I know they all are a challenge, which one would you select here? So I'll give you a few more moments to just go over that. And Gary and Ashley, if you want to chime in and let us know, what do you think is one of the biggest challenges that you're seeing in your process?
Yeah, so we don't chase different markets. We focus on a few markets so we could be experts in those markets. So I would say rising insurance rates and other operational costs are our biggest challenge. It's insane. We do a lot of our stuff in Arizona and we're paying the price for Texas, Florida, and other markets. We've seen as little as a 33% increase up to almost doubling our insurance costs. So not only is it could be a $50,000 increase, but when you divide it by the cap rate, you're talking about a huge cost to us when we eventually go to sell. So that's been our biggest challenge.
Interesting. Ashley, have you seen the same thing on your end, or are you seeing a different challenge where you're investing?
I think all of these are challenges. I think when you own multifamily, it really is a balancing act between managing all of these different items that are coming at you. To piggyback on what Gary said with respect to insurance, obviously there has been a massive increase in insurance nationwide, with Florida leading the charge, Texas following, but other markets not being exempt from being hit. So the problem is that it trickles down to ultimately the renter. And the problem is compounded by the fact that our cost of owning properties is rising at a higher rate than we can pass on to the renter. So what's essentially happening is, even though we talk about the inability and unaffordability to own homes, the gap is actually widening at a rate that renters aren't even recognizing. Today, it's on average about $1,600 or so across the country for the average rental price, where home ownership's at about $2,200. So not only do you have a home payment, but it's still so much more affordable on a monthly basis to rent. You also don't have all the fringe costs. But when you then have to absorb these escalating costs, it closer and closer to the cost of owning a home. The owning of a home gets pushed up as well because you have these residential insurance rates hikes. So I think everyone is kind of feeling the squeeze across the board with insurance. And then all of these other items, they're not, you know, not impacting property ownership either, because we're seeing not only laws come out, but really practices that are coming out. So for example, one market that we operate in is in Texas, Houston specifically. And the laws say one thing, but in practice, it's completely different. So in practice, what they're allowing for on the eviction cycle is a very exaggerated time for eviction. And we just received notice that that's supposed to continue on through December of 2025. So that drastically changes how we operate and impacts our overall operating budget.
Yeah, that definitely makes sense. And it's definitely better to put that in the perspective of the entire housing market to really see how it all plays together. Are you seeing any other sort of economic or demographic trends that are really impacting your decisions about investing in 2025?
You haven't seen as much before during COVID. You saw a tons of migration, and you're not seeing as much now. To Florida, to Texas. Certainly, there a lot of people are still moving there, but not as we were a few years ago. But but we're just in a cycle of a lot of still unknown with Trump being elected. What kind of things he's going to enact? He's talked about cutting taxes and reducing government spending, so there could be like a net there as far as not really seeing much inflation, maybe some disinflation. We have to see how that's going to play out, which will affect interest rates and other things. So there's still this big unknown over the next, I would say, 3 to 6 months, but we should be starting to see more deal flow because people have been kind of pushing out their deals for a while, particularly in the multifamily space. So there should be a little bit more opportunity coming. So I'm excited for 2025 and knowing that it's going to be a lot of navigating these kind of choppy waters.
Yeah, a little bit of a wait and see kind of strategy. Ashley, Houston was a really hot market. You mentioned you're investing there. Are you seeing any demographic changes since you first started in that market now?
Houston was pre-COVID and still is one of the most affordable places to live, and it's the best place to start a new business across the country. So Houston has had a reputation of encouraging people to live in the city, especially compared to other competitive cities within Texas. Most people don't even recognize that Houston is the fifth largest city in the US. So in terms of Houston being kind of a center for a lot of different folks to move to, historically that has been the case. But like Gary mentioned, during COVID, we saw this massive migration that was coming primarily from California, moving southeast and into Boise and Austin were the two hot markets where Californians were moving to. And then on the East Coast, we saw a lot of migration from New York to Texas and Florida. With respect to the demographic shift, there was a bit of a demographic shift during the beginning and height of COVID, but that has since subsided and it really has stabilized back to pre-COVID norms where industries are really dictating migration patterns.
Yeah, and actually considering where those industries are building their businesses or choosing to have their headquarters, Ashley, are you seeing any new markets that you're interested in, particularly for that reason?
Yes, there's one market that I'm interested in. I won't say what market that is, but yes, there are a few markets that we have been watching very closely to see what's coming into those markets and circling back to what how business friendly those markets are. So one of the things that is really interesting to see is the legislation in these markets, are they pro-business or not? And if they're pro-business, they can be pro-business, but do they take those extra steps to incentivize new businesses coming in? So that is something that we track very carefully and make sure that, like anything, there are market cycles. One thing that I didn't know about until several years ago was that not only does our economy have market cycles, but each local market has its own cycle within a specific asset class. So, kind of to put that into context, pre-COVID, years prior to pre-COVID, one of the reasons we selected Houston was only one of two markets in all of multifamily that was coming out of a recession. Almost all major MSAs were actually in the middle to the near apex of hyper supply, about to go into a recession. So Houston and actually Little Rock, Arkansas were two markets that were coming out of a recessionary period. So those are things we track pretty closely. And we do a market analysis every 6 months to make sure the markets we're in are markets we want to stay in. And then we also look for emerging markets.
I really like that approach. I think that is a really good place to look for, whether a place is good to invest in. Marcia was also asking, she said, no fair, share the one that you're investing in. But then she said, what's the second market you're looking at? And I think really what she's getting to, she also said, is what specific guideposts do you use to evaluate your choices? And you mentioned a few, Ashley. Are there any others that you think are worth mentioning here for our audience today that you're using?
For sure. One thing that I actually originated myself, and I don't know if you want to use it or not, take it with a grain of salt, but I created this metric called recession resistance. So what I look at is I look at historic performance during a recession, and I look at unemployment rates, and I look at not only what that specific market's unemployment rate is, but I use it in comparison to the nationwide unemployment and then the rebound. So what I'm really focused on is what is the spread between that specific market's unemployment compared to the US national average, and then how quickly a market can rebound. And then I look at that per recession, and I then look at what things has that market changed from the past recession. As recessionary cycles are typically 8 to 12 years in duration, it's important to not only recognize what happened, let's say, for example, during our last residential recession in 2008, but then also look at the safeguards that that specific market put in place to prevent exposure for unemployment in future recessions. So one of the things to look at is the diversity of economic sectors. So, for example, we liked Boise on all market indicators. We have a traffic light system where we rank all of our markets during our 6-month analysis. It's a red light is absolutely no, this is a bad data point. Yellow is proceed with caution. Green is this is awesome, really great data. Boise was green across the board, except for one thing, which was economic diversity. And it was the only reason we didn't go into that market pre-COVID. Now, a lot of people can look at that and say, hey, you really missed the boat on it. And maybe we did. The reason we didn't go into the market for Boise is one of their top 3 economic contributors was tourism. And tourism is an industry that does very, very well in upcoming market cycles, when market cycles are in hyper supply. But when you're overdue for a recession, which we were pre-COVID across the multifamily industry, that is something that we thought had a lot of exposure. So that's something, there's one thing to look for market, recession proof markets, but then also one thing to look out for is when there is lack of diversity in economic contributors to a market.
Very well said, Ashley. Those are all really good points. And I know, Gary, you essentially have invested mostly working on projects in Arizona. So clearly Arizona has had some of those indicators for you. What would you say are some of Arizona's strengths, particularly Phoenix, that you found have been helpful?
we love the low cost of living, business friendly, landlord friendly. You've got tremendous population growth, so above average national population growth, job diversity. Um, the bulk of our deals actually have been in Tucson because Phoenix,
Mhm.
there's it gets really hot and it gets really cold fast. So you really got to monitor it. Like we started off in Phoenix and then the market just kind of ran away from us and we found much better value in Tucson. Phoenix is a market we still like, but we're just constantly watching the data and looking for deals that make sense. For a while there, it didn't make sense, and now it's starting to make sense again. But you have to underwrite differently because that's a market that's got tremendous amount of new units. So you have to underwrite for greater vacancy, much more concessions. So by focusing on a few markets, you can really know what's going on and and adjust your underwriting for those times.
Hmm. Yeah, and I think it is interesting because you're working in a smaller geographic area, but you're still looking at the same sort of economic indicators to decide which deals to take. Um, so as far as other emerging markets, Gary, are you looking outside of Tucson now? Like, is there any other cities that you're sort of starting to research at this point?
Yeah, we've made offers on deals in Albuquerque,
Hmm.
and someone was just willing to pay more than us. We've made deals or made offers on deals in Vegas, that deals that we really liked, and again, someone was just willing to pay more than us, so we haven't been able to buy there. We're looking for another market as well, just because we have such a high concentration, and I don't mind it the concentration, but we focus on the Southwest. So I'm based in California. Most of my team's in Phoenix. So I want to be in an area that is business friendly, that is easy for us to get to. There are plenty of markets all over the country that I like. It's just not feasible for us to be going after deals in Florida. We're not going to be there on a consistent basis and whatnot. So we really want to mine the data for many years within a concentric circle around our base.
Yeah, I think there's pros and cons to both. So, you have either more diversity. It seems like Ashley, you're invested in more states and areas, but you have a higher concentration, Gary, in some specific areas that you know very, very, very well. Ashley, as far as what you're seeing as some emerging markets, I know you didn't want to share your top one, but are there any others that you're currently looking at or maybe think have some good promise for 2025?
Any market, especially major MSAs that are short on supply, it really comes down to basic economics, right? And basic economics dictates that price is driven when the demand outpaces the supply. And across the country, there are so many different markets. We have a platform that you mentioned before. I'm not trying to pitch the platform, but I'm just going to give an example. Often our students really struggle on selecting a market. It's one of the hardest parts I think about getting started is selecting a market. And the truth is, you can be successful in any market. It doesn't matter. There's a different business strategy for every single market. That's why there's investors in every single market. But when you look at it from the basic economics, you're increasing your chances of being successful when the demand is so much greater than the supply. You marry that with a barrier to entry with respect to units becoming available within that market. So it's either local legislation or, for example, interest rates. And that carves out an opportunity for anyone who wants to niche down and figure out a strategy that other people aren't putting the work into figuring out for you to be very lucrative. Most notably, one example of this is LIHTC properties, so low income housing tax credit properties. There is a lot of bureaucratic red tape into getting those tax credits, but it's highly lucrative because so few people pursue this as a business venture. And that is really market agnostic, but at the same time, there are certain markets where it is much easier to get those tax credits, less competition within those markets. So if you go after those markets and you almost do like a heat map where you look over top, layer over top. Okay, what is a market where the demand is higher than the supply, and marry that with it being just a little bit easier to access tax credits in that market. That's a market that you could pin as one that you should pursue. So I don't like to ever say that one market is a bad market. I just look at the basic economics, because sometimes we're all too smart for our own good and we kind of get lost in all of this data, and it makes it more difficult to make a decision when you really just have to focus on the fundamentals. Like oftentimes people are saying to me, well, how do you think about, what do you think about multifamily? Do you think multifamily is dead? Do you think it's a bad investment now? I didn't get into multifamily because I thought it was hot and upcoming. I got into multifamily because I believe in the fundamentals of multifamily. I believe we have a housing shortage that did not change during COVID. Yes, there are other factors that have made it a little bit different to operate. I wouldn't say it made it more difficult. There was difficulty prior to COVID. There will be difficulty 10 years from now that we're talking about too, but the fundamentals remain the same. And that's why I'm in this business.
Hmm. Yeah, I think once you know the fundamentals, you essentially, as you were saying, you can apply that formula really anywhere at any time to find good investments. And Ari, in the Q&A, by the way, if you guys want to ask questions, you can put them in the question box. I will be looking there. Ari kind of touched on what you were saying, Ashley. He says, I've noticed large differences in the value of investing in the same geographic area with kind of like micro neighborhoods. How do you navigate the minutia of a major metropolitan area you are investing in, especially if you don't live there and aren't personally familiar? So, touching on really getting lost in all of the details, and especially if it's a big metropolitan area that they're not familiar with yet because they don't live there, what would be, some ways they can get more familiar or maybe navigate that?
So you want to spend time there, go visit the city and meet with brokers and pick their brains. You should be reading the reports on a consistent basis. Maybe sign up for the business journal, so that you know what's going on in the city, what new employers are coming in, what new developments and stuff like that. Unless you're spending time there, you're not going to really know it. And you're not, and if you're not doing it on a consistent basis, you can still invest outside of your city, outside of your state, but you got to put in the time and consistently do it.
So, Ashley, it sounds like you have a good team behind you to help with that. So, if you're looking at, if you were doing this by yourself, right, then would you be more likely to have focused on just one market or just one area, or is it because of your team that you're able to really, look to multiple markets at one time?
I believe that you should play into your strengths. So, what is good for me is not necessarily good for someone else. I think what I'm really good at is managing people and being a leader. And I think because of that, it allows me to create good teams by filtering out people that aren't necessarily a good fit for what we're trying to accomplish. So whether or not you're a YIMBY investor or a NIMBY investor, like yes in my backyard or no in my backyard, that doesn't really matter, because either way you have to build good teams. One of the great things about multifamily is it is a team sport. You can go about it alone, but it's much easier to do with a group of people. I agree with everything Gary just said in terms of visiting the market. I would also like to add the caveat that sometimes, though, if you're in a situation where your partner is really the operator and your partner is the one who can serve as boots on the ground, you necessarily don't need to be in that role. You can provide another role for the partnership that allows you, maybe you're more strategic. For example, I think my husband, who does all of our underwriting, has been to one of our properties. So, if you're an analytical mindset and you like sitting behind a computer all day and crunching numbers on a spreadsheet, you don't necessarily need to be the one going out and understanding the market to a level that, that maybe someone who's going to overlook the underwriting is going to do. So I wouldn't say that you have these rules of thumbs that you just go off of and assume that whatever market you go into, those numbers are going to work, because they aren't. For example, the market that Gary's in Tucson has a significantly less expense ratio for the same type of property than we do in Houston, just because they have a lower tax basis. And that contributes heavily to the expense ratio. And if you don't really go into different markets and understand that, then when you go to underwrite another market, you're going to be like potentially, hopefully you're pleasantly surprised, but you could be the alternative and make a bad investment decision. So I really do agree with Gary that you need at least someone on your team who is an expert within that market. And that doesn't necessarily need to be you, but it needs to be someone on your team.
Okay. Yep. Team is the way to go in a lot of cases. We can't all know everything all at once. And I know sometimes it feels like we're supposed to, but there are experts in the things that we don't necessarily know, and we should take advantage of that and team up with them and really network. And that takes work too over the years to find out who is really a good person to have on your team, whether it's a broker or, someone who's actually working for you. So really good points there. Monique asked in the Q&A, do you recommend buying slum properties, or how do you assess a property? So I think like slum might be a harsh word, but Class C properties perhaps. Do you all invest in, any of those class types, and are there pros and cons? Have you looked into that?
Yeah, we start off in Class C. We moved up to Class B. We've made plenty of money in Class C. There's certainly opportunities there. Over time, it does, you know, your staff gets worn out because you have a lot more turnover. Maybe you have a little bit more crime, whatever it is. And you can't change your neighborhood. You could change a property. So I wouldn't mind buying a Class C in a Class B neighborhood. But it's going to be more work, and you're going to get more. Hopefully, you'll get more return on your money because there's more risk. So, like Ashley said, there's opportunity everywhere in every market in every asset class. It all depends what you're willing, what aligns with what you're trying to achieve. If you're focused on that asset class, I wouldn't say go to C and go to Class A and do things all over the place. Focus on what you do and do it really, really well. And then later on you can add another market, another asset class or whatnot. But if you're trying to do too many things, it's really, really hard to be successful.
Yes, and that is very, very true. Ashley, what about you? Are you mostly nowadays investing in Class A, B, any Class C properties you're looking at as well?
We've invested in honestly everything. So we've invested in Class A areas, B, C areas, but I agree. I think Gary said it perfectly, to be honest with you. So I don't have much more to add, but I would just say that the business strategy totally changes. So for example, if you can't change a location, but you can change a property, which was so perfectly said. However, when you think about it from a business strategy perspective, that's kind of the mindset I have with Class B and Class A. But Class C, for example, okay, I know that, and now how do I exploit that? How do I exploit that would be, I know that there are less buyers in the Class C space, so it's probably more I have a higher probability of acquisitions in that space. So maybe I buy the neighborhood and that's how I change the location. So I work with local city officials, I work with local businesses, and I do try to change the location. You can't change it overnight. That's why multifamily is typically a long-year hold, regardless of whether or not you're doing this strategy of buying the neighborhood. But when you buy the neighborhood, you can essentially buy on a scaling basis. So let's say, for example, you get one asset, you paid a little bit too much per door, but it's offset by another property you're getting a steal on, right? So collectively over those properties, you're doing well, and it allows you to control more variables in that market. So for example, you can spread not only your property management expense, but potentially you could even spread security expense across all those properties. You can use your unit count to leverage contract services. So you negotiate discounted rates across all of the properties, maybe with landscaping or utilities, etc., just because you have volume. So I think the point is that it really comes down to like what your strength is, because when Gary said that the staff gets burnt out on C-class properties, that couldn't be more true. But if you look at Class A properties, you're dealing with a whole different set of problems. You're dealing with higher expectations of salary. You're dealing with a higher clientele that is more likely to sue you. And you will be in a lot of lawsuits if you're in real estate. Like if you've been in real estate for a few years and you haven't been sued, then honestly, you just haven't done it long enough or don't have a big enough portfolio, because every single person gets sued in real estate. Like it's just the cost of doing business. So when you expand out your portfolio, you open this exposure, but you open up opportunities to tap into tax credits and other incentives with the city that, having a one B class property that has minimal headaches doesn't allow you to have. And all of a sudden you become like the star of the show by changing around this market, and you really can impact a community to such a high level, and make a really good home for all of these folks. So there's a lot of positive you can do too.
Absolutely. And Monique here says, comment, high value information regarding asset class types. So I agree. Corey says 100% true. 7 lawsuits right now. Well said, Corey. Good luck with your lawsuits. It happens to all of us. As we've been long in it long enough. And I think, Ashley, you also, mentioned something interesting, which is really the power in numbers and volume. And I think, we have members of all portfolio sizes that join the American Apartment Owners Association. For those that are looking to get into multifamily, true multifamily, that's really where you get a lot of the opportunities of, those costs going down overall, creating an impact in the community. But that's not always something that, people can look at their bank account and say that's feasible for them to do on their own, right? So that kind of brings us over to partnerships and syndication, which is something you all work with. And so kind of want to dive into that for those that are on the call and are looking to really expand, more than just with their own pocketbook. Gary, if you want to touch on that and what you've been doing to help investors, we could start there.
Yeah, for partnerships, it doesn't happen overnight. You need to develop relationships, and that's why going to conferences like the conference you guys had in Long Beach, and going to lots of other conferences, and you find people that you like, you enjoy working with. And it's great to have a network. Like, I consider Ashley a friend and someone that I can go to. Like, hey, if I don't know the answer to, maybe Ashley does, and if she doesn't, maybe someone in her network does. But I can't do that if I don't have a relationship with her. And so that's really important. But if you're looking to invest with someone, obviously you got to know their track record. Um, I think people have jumped in deals. I've jumped in deals in the beginning where, oh, my friend's investing with them. It's worked out pretty good. I'm just going to invest with him because I feel like he's done his due diligence, and maybe he hasn't, and that's led to mistakes that I've made in the past by investing with someone else. And I know a lot of people do that. So you got to do your own due diligence. Check on how their deals are doing right now. Um, if they're really struggling on some deals, maybe they're not making the best decisions going forward because they're trying to cover their struggling assets. Talk to other investors that have invested with them. And you should read my book, Invest Smart, as well. That talks about spotting red flags in real estate syndications.
Great. Well, we'll send a link out for that. Ashley, I'm sure you also have some great advice on this too. So I'll let you kind of follow up on what Gary said.
I'll take the question from a different angle because I think Gary did a great job covering that piece of it. So I think one of the biggest fallacies that people on the perimeter have of real estate investors is you have to invest with your own money, and that couldn't be further from the truth. That's something that honestly was a ceiling to my growth and development in residential real estate, because my residential real estate portfolio that I started with back in 2009 and built a multi-million-dollar high-end flipping business with my father was literally capped due to my own personal resources. I wasn't willing. I learned it later, and I was very skeptical about hard money lending. Now we got a lender during the process, but we only used our money for down payment and overages, etc. So I never had investors until I transitioned into commercial real estate. And one of the things that I think that is the most powerful tool that real estate provides, as opposed to, let's say, investing in the stock market, is this power of leverage. Now, you have to be very careful with leverage, because I know people who have not done so well because they've over leveraged themselves. So there's a smart way in which you can leverage other people's capital, and allows you to grow your portfolio and to focus and be an expert at operations or underwriting or construction management or acquisitions, etc. So my point is that if you don't have your own capital to get started, do not think that that's a barrier for you, that you can't get started. The great thing about multifamily is, I like to say, is you're not buying real estate, you're buying a business, and real estate's attached to that business. The reason why I like to think of it that way is everyone comes in with an existing skill set that they can leverage. So whether or not you're great at social media, you're an accountant, an attorney, you're good at operations, construction, I think you get the point here. If you lead with your existing skill set, you spend the correct amount of time doing your due diligence on partnerships, and you can find partnerships through conferences, which I know Gary already covered, local meetup groups, free online resources, coaching programs, you name it. There are more resources available to find your people, so to speak, than ever before. And then just lead with your strength. So lead with your strength. It does not have to be equated to a dollar figure in your bank account, and you can get started.
I hope all of you listening to that really take it to heart, because it would be a shame for it to really prevent you from growing your portfolio if that's, what you kind of feel like has to be done, is it has to come from you. So that was really well said, Ashley. Thank you. Corey says brilliantly said in the chat. I want to move on to talking about technology and efficiency. So, we've had several webinars this year talking about different types of software, or remote locks, showing listings without being there, different types of pieces of technology that really help to create that operational efficiency. So I'm wondering if Gary, if you want to start with any specific tools or systems that you've used that you recommend to really maximize that profitability in operations.
So one tool I love, it's not really going to maximize efficiency, but virtual staging. And you can create, if you have, whether you have only 4 units or 8 units, or even we do it on a 100-unit property, we don't waste a unit for a model. We can rent it out because we have virtual staging, and we take pro pictures of a unit and send it to a company. One of them is Box Brownie, and it's super cheap, and it could look, like a fantastic, luxurious apartment for fairly cheap, and then I can collect rent. I can collect my $1,200 a month times 12 months because I'm not having to keep it unrented. So that's one of the things we do. Another thing we do, we have large multifamily properties, so we've been putting EV chargers at all of our properties. It doesn't cost us a thing. We can make some money, and it separates us from the competition because very few properties have it. And so if someone has an EV car, they're most likely going to rent from us because we do have these chargers at our properties that are mostly sitting empty, but that's fine. I'm playing for the future. Then there's some tech stuff we can do on monitoring loan application, not loan application, but resident applications, because there is a lot of fraud, and delinquency has kicked up. So that's something that we've been using as well. I forget the name of the company that we're using, but that's something that we've been working with lovely.
Ashley, do you have any others that Gary didn't cover that you're seeing really make an impact?
So I'm going to make 2 points on this. I don't know if this is where you're going, but hopefully this resonates with some people. The first point that I'm going to make is with respect to how antiquated this industry is. So if there is anyone listening to the replay, watching live, if you have an idea, a tech friend, or you are in tech, this is the space for you. There is so much opportunity in this industry to revolutionize the way that business is being done on all fronts. Everything from the tenants experience to ownership groups experience to construction. I mean, you name it. There is a massive gap in this industry with technological integration and advancement. It is astounding how archaic we are doing things. I mean, if you ask most ownership groups, most groups are still using Google Sheets to manage everything because there isn't a system that really covers all the bells and whistles that we need it to cover. Or alternatively, they're using 10 different systems to manage because it's one system for investors, one system for sourcing, one system for managing a property. I mean, it is just very, very difficult to own, operate, rent, etc. That's the first part. The second point that I want to make, and this is where I'm going to sound like an 80-year-old woman who remembers the dial-up phone, which I do remember, by the way. But where I'm going with this is there is so much opportunity for technological advancements, but what we have found is we integrated all of these really cool features with respect to leasing, and our leasing actually fell off a cliff. And it's because we relied so much on the integration of the chat feature that pops up when you jump on a website, and automatic applications and self-guided tours. And yes, this is all great, but there is a human element that we have found that is really impactful in terms of conversion. So we actually took a different stance about a month or two ago, and our occupancy skyrocketed. So I would just say that regardless of what technology that you integrate, that you trust but verify, you still need to consider what the ROI on that investment is and if there's a way that you can do it better. So don't just sign up for any technological feature that someone's pitching to you because you think it'll be better. Make sure that you can test it out. Don't sign up into a long-term contract pushback. The industry is actually pretty flexible when it comes to negotiating these contracts. So I'd highly recommend trusting, asking for referrals, getting the proof first before you integrate something that you spent a lot of money, which is actually negatively impacting your overall operations.
Very good points, Ashley. And I think also, when you're looking at a solution, for something, for an issue, a problem, whatever it is, there are so many options out there that it can seem very overwhelming. And one option may be really good for one multifamily operator or landlord versus another. So it also really has to do with your particular needs. I mean, sometimes just naming one particular solution isn't going to make sense for everyone, even if it is really good for some people. So definitely worth, experimenting and trying out some of these new technologies. But as you said, trust but verify. So I want to also just quickly here. Ariel says, hello, would it be possible for you to share your contact information, like an email address, for more personal questions? So I will send the emails. If you all are okay with sharing them, Gary and Ashley, or your websites in the follow-up email tomorrow. And then we can give you your websites as well so you guys can connect with our speakers. And of course, the recording will also be there. So I think at this point, I've covered the questions that I wanted to have you all cover, but now I'm opening it up to the audience for any additional questions. I see a couple have come through. Nicholas, going back to the key members that you recommend having on a team, what functions should be covered i.e., building maintenance, finance, tenant relations. So Ashley, who do you have on your, or like, what are the functions that you have covered on your team?
This is a great question. We actually have different layers. So there's the ownership group in terms of the roles that are played, and then there is the boots on the ground. So with respect to the boots on the ground, I'll start there first. We have a property manager that oversees each individual property. So they're the leader of the property, they're the leader of the business plan. They are there day in and day out, and they're managing the team, but they're managing the overall asset as well. And then in addition to them, we have an assistant manager or leasing agent. It really depends on the size of the property. We have typically an algorithm which equates to, for every 100 units, we have one person who we call in-house and one person out-house. So one person would be someone you would see in the leasing office, and then one person outside would be someone like a maintenance, a lead maintenance, assistant maintenance, janitor. We've also integrated virtual assistants to assist with our calls and touch points in terms of leasing. So what I mentioned before about how we did all this tech integration and it kind of backfired and it didn't really hit well with our tenants, we then backpedaled, and then we now have all of our leads go through our virtual assistants. And I'm happy to, share that information with anyone who wants. Just send that to me via email, and I'm happy to connect you with the company we use and have used for over 2 years. But that has made a tremendous difference in terms of how quickly you get in touch with tenants to convert them and handle even work orders or complaints. It frees up the time on the staff, the in-house team. From a second layer, in terms of the ownership, we have someone who leads up acquisitions, underwriting, investor relations, works with legal and CPA in terms of our tax accounting, etc., asset management, construction management, and then we have support for all of those roles as well. So it really scales, and I'm sure Gary will agree that it scales. It doesn't start off that way. So for anyone who's listening who hasn't gotten started and they think, well, that's way too much, just remember that every single person, myself included, started just as a one-man show. So I started by myself. I started not only this company, but even when I started in residential real estate, I started by myself. So don't think that this happens overnight. You kind of look at Instagram right now and see these overnight success stories and don't realize that I actually started investigating real estate and investing in real estate back in 2007. It took me 2 years to get my first property in 2009, and it's taken me a long time to get to where I am today. So you can all do this so much faster and achieve so much more than me and Gary. I hope I'm not talking out of turn here for you, Gary, but you can do it so much faster than we were able to do it, because when we started, no one was sharing this on YouTube. There were no events like this. There were very few conferences. Really, Bigger Pockets was like it, to be honest, and maybe Rich Dad, Poor Dad, the book. But other than that, we were all kind of in our own little islands, and tech has really brought us together and provided an opportunity for all of you to scale so much faster and build so much more and get to financial freedom so much faster than Gary and I have been able to do.
That's a really good point. I do think that we do have the benefit of really connecting with so many more people than we did back then. I mean, even LinkedIn, when it first came out, isn't what it is today. So, Gary, do you have any follow-up on that?
As far as team, yeah. We talked about partnerships before, yeah. I think when I started, my mindset was I've got to do it all myself. And that I have to do a 4 unit, go to an 8 unit, then maybe graduate to a 12 unit. This was going to take me many, many, many years until I went to a program and they talked about teaming up, which, Ashley mentioned before. And that really led to my growth by sharing resources with other people. And building confidence in what I was seeing. Like, we'd underwrite a deal and are you seeing the same thing? And I am, what are we missing? And doing it with someone else, you build that confidence so you can get over analysis by paralysis and take steps going forward. And so that led to doing more deals and eventually hiring a operations person who helped out with investors doing paperwork and doing all the behind the scenes stuff. And then ultimately hiring an asset manager on our team to really mine the data. And so I could work on more of the deals and putting together partnerships with people. And then we hired an investor relations person and then another higher level operations person. So as your team grows, then you could start going from there. But you need good partnerships. We use third party property management and we rely on them, but we manage the manager, trust but verify. And so it allows us to focus on what we do best and leverage those partnerships.
Great. Yeah. All good points. I'm going to go over to the chat here. Pedro put in an interesting comment. He says that he got out of owning apartments and got into triple net deals now, but now he wants to get out of owning a Dollar Tree. What are there better options to reinvest? And I suppose that's a personal question. It kind of depends too on, what interests you, but I'd love to hear your thoughts on what would be a way to kind of, pivot if you're in a situation like that. Ashley, if you want to start.
Yeah, sure. So I always like to tell this story because I think it's a perfect story and it's a real life story. So I met this doctor and an investor, and I was just kind of learning about his story, how he got involved in real estate investing. And he said, "Oh, well, all of my friends, is actually, excuse me, it was a dentist, also a doctor, but different practice than you're probably thinking. But anyway, this dentist who, he said all of my other dental colleagues, my other dentist friends, they were all in real estate. So I wanted to get into real estate because everyone said, this is what you do. This is what everyone does, invest passively as a real estate investor. And everyone invests in syndications. You don't have to manage anything. You have limited liability, which is what limited partner, that's what it means by the word limited. This is the route to grow your wealth. He said, a year in, I looked at my situation and I thought to myself, what am I doing? Because I don't need to grow wealth. I owned dental practices. I need tax write-offs. And this just isn't cutting it. There's got to be a better way for me to limit my tax exposure. And that's when he switched and started investing in oil. Now, you can invest in oil in so many different ways, which I never knew about until a few years ago. You can invest in the land, the raw material, the oil itself, the byproduct of oil, the machinery. I mean, there's so many really nuanced ways that you can invest within oil, but somehow he was invested in oil. I'm pretty sure it was with the machines, but I'm not positive. But the point of the story is that he followed this red ocean. He followed and he swam in this red ocean because that's what everyone was doing. And what he realized is he didn't need to swim in this red ocean. That's not what he needed. What he needed was tax write-offs. And yes, real estate gives you some, but it doesn't give you the most tax write-offs. He was talking to other dentists that he had typically associated with, but they didn't own practices. They didn't need the same tax write-off. They needed more minimal tax write-offs than he needed. So he transitioned out of real estate and invested in the oil industry. All this to say that I think whatever you invest in is, like you said, a personal decision. Like you have to determine what your current situation is and what you're hoping to achieve by investing. And we have we work with a CPA firm for our personal taxes. And our strategy is, how do I not pay federal taxes this year? Every single year we have a planning meeting, and that is our goal. My husband and I, that is our current strategy. Every single year we meet, and that is the goal of the meeting. And they outline a road path for us to execute that year. So we limit our exposure of paying federal taxes. We've set up our entire structure that way. So I think you need to have someone in your corner. We use Markham. I don't get any affiliate fees for mentioning their name. We've worked with them for probably close to 20 years now. They are nationwide. They have specialties in all different industries. I highly recommend them. They are a bit expensive, but they've saved us probably 10x to 20x what their cost is. So I really don't care, to be honest with you. But the point is, you need someone in your corner. It doesn't necessarily have to be Markham, but it has to be someone who can focus on your overall strategy and help you achieve your goals, whether it be limited tax exposure, wealth building, or wealth preservation. But ultimately, you need to figure out what your strategy is, and then you need to develop a plan and execute on that plan that leads you closer to your goal, not further away.
Yep. Well said. Well said. Nataya in the Q&A says, Ashley Wilson, I don't like you, but love your honest speech and sharing the facts to all of us. I salute to you sharing and giving, you paying it forward. May your family, your team, and Gary have good blessings in life and all fields indefinitely with a clean bill of good health always. All right, Nataya, I love you for that. Thanks for the comment there. Ari, moving on here to another good question. I'll give this one over to Gary. What are your biggest challenges with investing in duplexes and multifamily homes compared with apartment buildings? So I guess what he means by multifamily is less than 5 units compared to apartment buildings with more than 5 units, maybe. It might be the question. So Gary, as far as like when you started, did you eventually graduate and what were some of those challenges that you saw that were different?
Yeah, so I'm a scale guy. I've owned lots of businesses before. So um I did some single family and then quickly went to a 42 unit. And so we bought our first property we paid 1.65 million for a 42 unit. So I should have bought the whole block at that time. Um, but it's easier to get staff. It's easier to manage a bigger property, whether you have a 20 unit, 100 unit, or 200 units. Now I know it gets a lot more expensive. It's the same amount of work as managing a 200 versus a 20 unit, but you got to have the right partners, you got to have the right team, you got to have that experience. So if you can go to scale, it just you get better staff. It's easier to operate. So I would recommend that route if you can.
Yeah, definitely. Okay, I think a couple people asking for Ashley's CPA name. Markham, she put it in the chat, Marcum. So you guys can copy that and look into it. Thanks for that,
If you,
Ashley.
yeah, and no problem. If you send me an email afterwards, I know that you're sharing our email addresses. I'm more than happy to do an intro to my contact as well.
Amazing. Yeah. And if each of you wants to put your email addresses in the chat right now, or at the end here, we can, make sure that if people wanted to email you right away, they get it. So I'll let you put that in the chat there. Thanks. All right, perfect. And also Carolyn asking just one more question here in the Q&A. We'll see if any others pop out because I know we're over the hour here. Um, do you ever poll your tenants to see what they would like to see by way of amenities? Um, so I'll hand that over to Ashley if you want to go over some of those amenities that maybe you've polled your tenants for, or how you've chosen really to have the amenities that you do in your rental properties.
I'm going to start by telling you how not to do it, and then I'll tell you how we actually have done it. Because I made the mistake of what I'm about to tell you. So this is why hopefully you can learn from my mistake. Another great reason that you should attend these things is you can learn from other people's mistakes and you can leapfrog over them and not make the same mistakes. So the way that I did it the first time was we had a bunch of ideas because I am a little bit of a visionary and ended up giving out all of these ideas and then just sending out a poll and saying, hey, what do you guys think of these ideas? Like pick your, rank 1 through 3, and we're going to add this feature on the property. That is the wrong way to do it. The best way to do it is, and we learn the hard way, the best way to do it is you're going to come up with ideas internally. You're going to analyze them from an ROI perspective. And if the ROI on these is the same yield, then you can present them all to, your tenant base. Because ultimately, what you want to do, you have to remember that it's still a business, and you need to create an environment that not only is good for your tenants, but also is a smart business decision. So this is a way that I think you can marry the two concepts, and I feel that you can get your community involved so they feel like they're part of the decision-making process. Going back to the error that we made initially when we did it years ago, where we just sent out this blanket pick your favorite. First of all, we didn't analyze it on an ROI perspective. So ultimately, we exposed ourselves to investing in potentially the worst outcome for us. Number two is the whole reason we were adding an amenity was, to be honest with you, most of the time it's to create an upcharge. Now you can say to yourself, well, adding a playground doesn't create an upcharge. It doesn't create a direct upcharge in terms of other income, but what it does allow you to do is it does allow you to increase your monthly rent, right? You're creating more demand. You're attracting now more families to the property potentially, and those families, by creating more demand, and you have a finite amount of supply, once again goes back to basic economics, that you now are in a position where you can raise the rent. So you're essentially asking the community of existing renters, I put renters and tenants combined in one word, if you didn't catch that. But you're basically asking these folks that are existing for their business input on what you're trying to attract in the future. So that's not necessarily always a good idea, because there is probably a high probability that the folks that are currently in the property, by adding that amenity, might not be your avatar in the future. So that's why you have to just be a little bit careful in terms of just putting it out there and saying, hey, do you prefer a dog park or a playground? Because there are different ROIs. You might be in a downtown city where you're attracting currently families, but you want to transition over to, because you have primarily one bedrooms, you want to stop attracting families and attract young professionals, because you can push the rents more, and they need green space for their dogs, because the avatar for a single person, especially someone who is a pet owner, are actually more likely to pay a higher rent, and maybe you want to attract those folks. So these are just kind of things you want to really think through before you just try to be very appeasing to your tenants, because I can tell you, when you don't pick what some people want, they will let you know. And they have let us know. So learn from my failed experience, and hopefully you eliminate that exposure.
That's an interesting story. Because you'd think asking them would result in a better, I see why you went that route to start. Gary, have you had a similar experience as well?
I never put it to vote. We sometimes will have our property manager poll a few people just to get some input. But yeah, never done a full survey. But it's every place is kind of limited in space or what you can do and your dollar. So yeah, your ROI is always is so important. Like where you want to take the property, what's best bang for your buck. Dog parks is one of the things we love to add on our communities. It's very inexpensive, and most people have a dog.
Yeah, especially now. Yeah. And I think that's a great note for us to end on. ROI is king, and especially when it comes to amenities. And I think, with that said, let me just wrap up that, we're going to be providing this full recording to everyone tomorrow, as well as any resources or the contact information of our speakers today. K Properties and Investments, as I mentioned at the beginning, is our sponsor. So we will be sending you some more information about that, as well as a link to our next webinar, which will be next week on cashback and tax credits for landlords. Definitely a good time to start looking at some of those tax incentives, and also some new cashback benefits that AAA members are going to get through our partnership with MasterCard. So, Ashley, Gary, Honestly, this was amazing. You all have so much experience and so much wisdom to share with our members. I hope to have you back again sometime so that we can reconvene. It seems like everyone learned a little something new, something a new perspective, and I'm getting great presentation. This was awesome. So a lot of thank yous in the chat, and I'll leave it at that. I hope that we all will see you on the next webinar. And Ashley and Gary, thanks again.
Thank you.
Thanks for having me.
Take care, everyone. Bye-bye.